Welcome to The Explainer. Today, we're diving headfirst into the hidden mechanics of professional asset management. We're going way beyond the daily ticker symbols to uncover how the big institutional money actually moves, how it behaves, and, maybe most importantly, how it protects itself. Here is our roadmap for today: the investing illusion, the active management myth, finding the dusty corners, the hidden light. Moving on to our second pillar, risk. Because let's face it, a genius strategy in a dusty corner is completely useless if the execution crushes you. There's a really dangerous illusion in modern markets. We tend to equate narrow bid-ask spreads with safety and high liquidity. You look at your screen, the spread is tight, and you just assume, hey, I can exit this position instantly. But that is an absolute illusion, hiding some pretty deep structural market changes. Check this out. Data from Guggenheim reveals a truly startling trend. Primary dealer inventory of corporate bonds has absolutely plummeted since the 2008 financial crisis. Wall Street dealers completely shifted from a principal model where they held inventory and basically acted as massive market shock absorbers to an agency model where they mostly just match known buyers and sellers. So sure, the liquidity looks totally fine on a sunny day, but that underlying structural buffer, it is completely gone. Which brings us to how we actually need to define liquidity risk. It isn't just about your ability to sell an asset on a normal, boring Tuesday. True liquidity risk is about the massive and honestly sometimes devastating cost of being forced to sell your assets for cash when the market freezes up, volatility spikes, and literally everyone else is rushing for that exact same narrow exit door. If we peel back the onion on credit spreads, we find a pretty big surprise. When you buy a bond, the yield spread you get over a risk-free rate isn't just one big block of profit. Guggenheim breaks it down strictly into compensation for default risk, downgrade risk, and, crucially, liquidity risk. As you move down the credit spectrum from AAA to high yield, pay attention to how that liquidity risk premium expands significantly. You are literally being paid to take on the risk that you might get stuck holding the bag. And in practice, this liquidity risk carries a massive price tag. To put that in perspective, when transitioning from normal to stressed market conditions, a $50 million BB high-yield corporate bond sees its transaction costs double, going from 50 to 100 basis points. And for esoteric assets like aircraft asset-backed securities, it quadruples from 10 to 40 basis points. In a panic, you aren't just losing time trying to find a buyer. You are bleeding massive amounts of capital in transaction costs alone. Section 5. The ethics of investing. The rules of the game. Finally, we arrive at our third pillar, trust. You know, pop culture and movies, like The Wolf of Wall Street, love to perpetuate this myth that the global market operates on pure, ruthless arithmetic, total lawlessness, and unbridled greed. But if that were actually true, the complex mechanics of global asset management would collapse overnight. The reality is that the entire system rests on an unyielding and largely invisible foundation of fiduciary duty and professional loyalty. The CFA Institute really sets the global gold standard for these rules. And this isn't just some corporate suggestion box. Their code of ethics and standards of professional conduct is literally what ensures that high ethical standards maintain public trust in the financial markets. Because without that trust, the liquidity we were just talking about dries up entirely, and those fancy alpha strategies become completely impossible to execute. Instead of bogging you down with dense legal text, let's distill the 6 main duties down to their core. Pay special attention to the third duty, loyalty and prudence. Before a portfolio manager ever buys that high-yield bond or wades into some dusty corner of the emerging markets, their absolute first obligation is to make sure it aligns prudently with the client's actual risk profile and objectives. The client must always come before the firm and well before the manager's own bonus. Section 6. The Modern Investor's Toolkit, bringing it all together. So how does all this build a complete picture for you, the modern investor? Well, the true life cycle of a successful portfolio requires all 3 of our pillars. Step 1, pick the right strategy. Use cheap passive indexing for highly efficient large cap markets, but don't be afraid to deploy active management in those dusty corners where alpha actually still lives. Step 2, constantly calculate your liquidity risk. Know exactly what it will cost you to exit a position when the market turns against you. And step 3, demand ethical execution. Make sure the professionals handling your wealth are operating under strict fiduciary standards. Which leaves me with a final thought for you to investigate in your own investments. How balanced is your portfolio right now? Are you over-indexed in areas where active managers could actually be finding you an edge? Are you sitting on unseen liquidity risks, completely disguised by narrow bid-ask spreads? And most importantly, do you implicitly trust the fiduciaries managing the hidden mechanics of your wealth? It might be time to take a look under your own hood. Thanks for joining me for this explainer, and I'll catch you next time.